Thanks, Carol. I'm standing by right now with Jason Pryde, the Director of Investment Strategy at Glenmede. Let me ask you about what's happening right now, because everybody was so focused on Greece, and it seems to be that investors are now sitting on their hands just waiting. Are we in the final minutes of this drama?
It seems like the Greece situation is in some of the final minutes, but we haven't resolved the bigger picture situation here. You know, the banking system in Europe still needs a true recapitalization, just like what we did in the U.S. The austerity plans in Italy and Spain have to show progress so that we don't have to do more work in those major countries, because that's where the big debt balances are. So there's a lot more work to be done, but it's nice to see some correct action in Greece.
So you're optimistic on what's going on in Greece, because it seems like a lot of people are discounting Greece as now a done deal, goners, and let's worry about Italy and Spain, as Mark Dow, I think, has put it.
Look, everything here is it has to do with the on-the-margin movement. You know, Greece ultimately is probably going to have to default and restructure their debt. The question is, how much pain do the banks have to endure when they do that? How much debt can they sustain? So every incremental move changes the picture. And this is one that's in the positive direction.
What do you guys do? You oversee more than $19 billion in assets. Have you cut off risk here? Have you adjusted your positions to get even? And are you in waiting mode, or are you taking bets?
So we've been taking a below-average risk position in our overall investment landscape. By doing so, we've protected investors during this tumultuous time. But we've been doing so in a way, in my mind, it's always a try to protect the client's assets, but not forfeit the long-term returns. You could easily forfeit long-term returns in the wrong way by buying treasuries and gold at this point.
You know, you're right. There is, the only thing we can kind of count on nowadays is volatility at this point, Matt. And as you know, we're kind of glued to the news out of Europe and Greece specifically today, but really all over Europe. But we're also kind of continuing to question what happens with the U.S. economy. I bring that up because we spoke with economist Martin Feldstein, who for the better part of 3 decades helped determine when recessions start and end. He spoke to Bloomberg earlier today about the prospect of another recession. Listen up.
Yes, I would say we are more likely to be in or heading into a recession in the coming year than we were before, and more likely than not.
Jason, I know in your last note you wrote about the prospect of maybe going back into recession. Where are you on this for our audience, and how is that kind of impacting your investment thesis at this point?
Sure. So, we think that there's a possibility of recession here. We think it's less than 50% at this point in time, but it's uncomfortably high. 20 to 30% chance of recession at this point is realistic. We're running at a slower than normal growth rate, and when you're running closer to zero, it's easier to get to zero. So that risk is there. Investors have to protect themselves from it, but still, we think they should protect themselves while attempting to do so in a way that does not forfeit long-term returns.
You mentioned not buying gold, for example, right? Even though when we come down on a day like today, $17.81 an ounce almost looks cheap.
It's hard to say that $1,700 an ounce looks cheap.
Well,
we
really.
Look at it in these valuations. Current price of gold is basically 90 to 100% above where it should be on an inflation-adjusted basis. It's hard to look at that and say that that is a protective asset for anybody in our eyes. Treasuries sit similarly. So, investors that are buying treasuries and buying gold at this point in time are really doing themselves a disservice for 5- and 10-year returns.
What can you do to preserve your capital? I mean, I was talking to a guy on the airplane yesterday. He's a treasurer of a company. They have $160 million in cash, and he says, we're paying 15 basis points to a money manager who gets us 5 back in short-term securities, in short-term treasuries. So we're basically paying 10 basis points for him to hold our $160 million. It'd be better to keep it at home under the mattress.
Look, we think, this is a kind of upside-down investment environment that we're sitting in today. Investors need to take a little bit of an upside-down approach to their investment portfolios. Typically, investors look at their fixed income as their protective basket and their equities as their risk-taking basket. What if you actually turn that on its head and you try to find protection in equities by dulling down your market exposure, by buying safer equities, and actually take your risk on the fixed income side? Basically move both ends of the spectrum into the middle to protect your portfolio instead and still position yourself for long-term returns.
Hey, Jason, talk to me about what equity plays you like at this moment.
Sure. So in equities, following along that thought process of defensive, protective investments in equities, we're focused on higher quality, dividend-paying equities, particularly things like Philip Morris International, Colgate-Palmolive, Yum Brands. The idea is to protect portfolios on the equity side and still have those attachment points towards emerging market consumer-driven habits.
As I'm looking at Philip Morris right now over the last 3 months, it hasn't done terribly well, but aren't you concerned that investors are piling into those stocks? I mean, that's what I would think too, right? You want to get a quality name that's paying a decent dividend so you get some kind of return. Isn't everybody thinking that?
Look, investors are piling into those sort of investments. They're also piling into the more defensive investments like treasuries and cash and gold. We'd prefer to be in an investment that still has the potential of giving you a long-term return to protect your assets than piling into an investment that's going to give you 2% for the next 10 years.